Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day, let's get you the three catalysts we're watching this hour. First up, we'll break down the market action as stocks rebound on tariff optimism. We'll bring you the macro and micro picture ahead. Plus, we dig into Tesla's price action as the stock rebounds today, but flirts with 10 weeks of losses. Will the gains hold? We'll discuss. And we'll talk about the state of venture capital and artificial intelligence as tech valuations drop to pre-ChatGPT levels. All that and more coming up on Catalysts. Half an hour into the start of U.S. trading, let's get a check on the markets here. Taking a look at the major averages, continue to see them moving to the upside off the back of this idea that we might not have as stringent of tariff policy as previously reported. That is according to reporting from Bloomberg and the Wall Street Journal. I also do want to point out, though, that the PMI data crossing the wires this morning did add weight to the idea that we do have more growth coming to the economy here. You had the highest prices paid level since April of 2023. That doesn't really sound like Fed easing, but it also doesn't sound like a recession. So maybe you're seeing a little bit of movement to the upside off the back of that strong PMI report here. But no surprise if we do flip the board over to the bond market. We are seeing yields rising off the back of that as well. Again, off the idea that we will have a potentially higher for longer environment, as it does look like prices paid were higher than they have been since April of 2023 in that economic data. But finally, let's take a look at our favorite risk on, risk off indicator here. Bitcoin in the green. It is above 87,000 this morning. Markets getting some relief as the White House offers a more targeted approach to its April 2nd Liberation Day tariffs, as first reported by Bloomberg. Joining me now, Yahoo Finance's Washington correspondent Ben Werschel. Ben, thanks for being here. Great to see you as always. Yeah. Also my Capital Gains co-host. Yeah. What exactly has changed here for April 2nd?
Yeah, so what I tried to write about in a story coming for Yahoo Finance today is it's sort of, this is obviously a real market boost, but it really kind of all depends on how you define narrowing. This is an effort that stretches all the way back to last week. Kevin Hassett last week had some comments about just a few countries being targeted. Scott Besson had an idea of the dirty 15% of nations that they're targeting. The problem here is that 15% or those just a few countries make up the vast majority of America's trading partners. Even the Trump administration released a federal notice back to start this whole process in February that noted they're looking at countries that make up 88% of America's trading partners. However, it's about 20 countries, but that represents basically the entirety of U.S.'s trading partners. So the question here is exactly whether they're going to narrow on those. And if you narrow it down to those, it's still sort of all U.S. trading, and there's still a signal that they're planning to do big duties on those countries when they come in. The other element of this in the reporting over the weekend is that sector-specific duties may be delayed, and that would be a big concession in terms of certain sectors like pharmaceuticals, semiconductors, things like that. The other part of that, though, is that a lot of these may have had to been delayed for legal reasons. What this process that's ending next week is about nations, and then a lot of these other ones may require comment periods, may require their own investigations before the tariffs are coming into place. So the core of the Trump idea, I think, is still intact here, even though there's definitely been this messaging effort to sort of talk about narrowing.
And Ben, the question that I'm kind of obsessed with today is the root of the reporting on this tariff shift from the Trump administration. Is this coming from the president's mouth? Is this an idea that the president does care about the market, or is it his economics team doing some damage control?
It's definitely the latter for right now. It's the economics team. This is sort of a process that's been going on from this in response to these market jitters. This reciprocal day, this reciprocal tariff day. Trump has called it Liberation Day and sort of been all in on it. He did offer a little bit more market-friendly commentary on Friday, talking about he had some flexibility. He seemed to be talking about company-specific there, so it could be a good sign for specific sectors. I would also note, I think it is notable that he hasn't knocked down these reporting over the weekend yet, at least as of a couple minutes ago. This was not the case in previous ones. Anytime there was a headline that sort of suggested he was backing away from his tariff plans, he was quick to post that was wrong, fake news, blah, 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 and that he has not done that yet. It could happen any minute. But that's notable here that he's not immediately reacting to the idea of a kind of narrowing idea, which markets clearly like.
Yeah, and important for investors to not get over their skis on that reporting, it sounds like.
He can undercut his aides really quickly, for certain.
Absolutely, absolutely. Well, thank you as always for joining us, Ben. Really appreciate your insights and your reporting.
Talk to you soon.
I want to welcome in Ann Berry. She is the founder of Threadneedle Ventures, a 15-year veteran of private equity deal making, and she'll be with me for the hour. Lucky for our guests listening in, because Ann, you give such great insights on the markets. I'm really excited to be with you to talk through the action we're seeing today. Finally, some movement to the upside, but I'm wondering how shaky this ground is right now. How much staying power does this have, and does it make April 2nd more risky? Because we will get those reciprocal tariffs that day, but if we haven't priced in enough risk, how shaky does that make our ground and our footing?
It does feel like a roller coaster ride, right? The tariffs, they come, they go. It feels like we're always one national security policy away. We're one effective lobbying campaign away from these tariffs being revoked or adjusted. So I agree with you. We're seeing this rebound in the markets, but it could just as quickly go the other way.
It could just as quickly go the other way. And we've talked a lot about the dip buying activity that we're seeing. One thing I was interested in to chat with you with is this ETF activity that we are seeing. A lot of retail investors in particular pouring into ETFs. You can see on this bar chart here, the Vanguard S&P 500 ETF soaring. And then you've got a triple levered QQQ ETF just ripping off of the February lows here. That's going to be the bottom orange line on your screen there. Is this a sign of optimism under the hood, that we are still seeing flows into risk assets?
I think it's a sign of FOMO, and I'm going to be really clear on what I mean by that. You just said it at the top, right? A lot of this activity is retail investors coming in, and I do think that there is a part of this where if you're a retail investor who sat out the market, do you remember in 2022? Because the bad news was coming in, you really missed out. QQQ is one of the bellwether tech stocks. It's highly levered. It's a bet on a bet on a bet on tech. This to me is the ultimate FOMO, buying the dip. And I think it's actually as much emotional as it is analytical at this particular moment in time. And I understand it. I have empathy for it.
Right. Well, I know that you look at those big tech names as well. So what are you thinking about the tech trade right now and where it's heading?
Well, I think there are different components of it. So I'll tell you what my personal feeling on it is, and then I'll explain why I understand why this rally is happening. My personal focus around big tech is a year at 2025, you and I have talked about this in the past, where all of this narrative around AI, the capex, the mega acquisitions like Google buying Wiz, these companies are under enormous pressure to show real, tangible monetary return on these AI investments. All that being said, big tech has been hit by, is the quantum trade real? Right, it's been hit by tariffs in China. What does that mean for our export market? What does it mean for our inputs and our components? It feels as though the sentiment around the latter is getting more optimistic. To your point, it's shaky ground. We don't know if these tariffs will stick. But I do think the discipline around what's going to happen with AI-driven capex is not going to go away. So I'm a little bit worried about piling in too much to this right now.
Well, and it's fascinating that you say that in the context of what we're seeing with Alibaba's and as well, this announcement of another cheaper AI model. They used AMD's chips. They did not rely on NVIDIA chips, but then you've still got NVIDIA rallying today along with the rest of the market. So I'm not seeing a DeepSeek sell-off off the back of this news. Why is that?
Well, NVIDIA at their recent conference didn't quite walk back, but do you remember last time CEO Jensen Huang said, quantum's a long ways away. Right, we're instead at NVIDIA going to focus on physical AI, and he really doubled down on this narrative around robotics and automation. Well, there was a little bit more of a positive body language around quantum at the recent NVIDIA conference, and I think that's why we're seeing a bit of a snapback in some of these quantum stocks.
And it sounds like, though, you do not foresee huge legs to this tech run, maybe a little bit of trepidation still.
I have a little bit of trepidation. I think the other piece of this, too, is the tech trade is so sensitive to interest rates, right? And it feels as though last week and the Fed talking about there's still going to be another 2 rate cuts on the path that we all thought. I feel like that's given some confidence too. I think people are saying if the cuts are coming as expected, then tech's back on the table.
All right, tech back on the table. And thank you so much. You're going to stay with us. We're going to talk about the tech trade a little bit more because valuations for some of the biggest beneficiaries of that AI rally have dropped to their pre-ChatGPT levels amid yet another risk here. Jack Ma's backed Ant, the company touting an AI breakthrough using Chinese chips and AMD chips as well. Meantime, top executives from Apple, Qualcomm, Eli Lilly, and more gathering in Beijing for the China Development Forum. So what's next for the big tech trade? Joining us now, Sarah Kunst, Clio Capital Managing Director. Sarah, we always love chatting with you. Thank you so much for being here. So these tech valuations dropping back to their pre-ChatGPT levels. What would you say is the biggest risk right now for the large cap tech names? Is it U.S. specific risks in the form of policy, or is it a tech specific risk coming from all this competition bubbling up?
So I think it's actually something a little bit different, which is that tech is not a monolith, right? And I say that and I say that and the market ignores me. And what I mean by that is that it's not the same, right? Tesla's big risk is, besides the Molotov cocktails, is that people don't necessarily want to buy the exact same sedan that they've been able to buy for what feels like a decade now, right? So they have a product risk and a CEO risk, whereas you have names like Alphabet, where I think their risk is certainly not in tariffs. It's not in physical goods because they don't sell that. It's in other more existential things like, are we actually going to use search in a world of AI where we go to an AI chatbot first to ask questions? And so what's that going to do to their advertising business? So these aren't a monolith, and some of them have tariff risk, some of them have tech risk, valuation risk, PR risk, but you really have to look at them as individuals, not just a basket.
So Sarah, within all of that and looking through the monolithic narrative, as you point out, where are you seeing opportunity? Where would you say, public investors, this is the spot where there's a window to put some money to work?
So I actually do really like Alphabet. Like I mentioned, I think that they have this question mark of, if search declines and that ad revenue declines, what do they do for money? But they are an incredibly prolific, very smart company and team. And so I think it matters that the odds now that they get broken up the way that the last administration was talking about, those odds are probably pretty close to zero now. It's unlikely we're going to see a Chrome spinoff. So I think that is a good thing for them. And if they can figure out sort of, hey, how do we take all these really fascinating businesses like the Waymos of the world, like DeepMind, and actually make some real money with them, I think that there's a huge opportunity for them.
And Sarah, on the flip side of that, what's a name that you are avoiding right now?
I have to say, I can't call myself a Tesla bear, because being a Tesla bear is probably the best way to lose money. But I am always bad and continue to be a Tesla skeptic. And I think that, you look at BYD. I was in Riyadh recently. I was in Mexico City recently. That company is everywhere. The cars are good. They work. They're incredibly affordable. And just because they're not allowed to be sold in America doesn't mean you can discount the, close to 8 billion other people on the planet who are likely, probably in 10 years, much more likely to be driving a BYD than a Tesla. And so, when you look at the valuation of Tesla, one thing I always look at are kind of PE ratios. Tesla's is around 130 right now, whereas Toyota, the world's biggest automaker, is barely above 7. And so if you right size that Tesla trade, you have lost not just your shirt, but your socks. You are swimming naked. And so that is a name that I'm not going to short it, but I'm certainly not going to touch it.
Sarah, you spend a lot of your time in the private side of the tech industry, investing in private companies. What are you seeing in terms of valuations? Have they been tracking these roller coaster swings in public equity tech valuations we've been seeing?
So there tends to be sort of this most popular kid at the party effect in tech, where at any given time, there will be one or two companies where I can call up any of my friends or investors at the biggest funds on earth, and they are chasing that deal. They have seen that deal, right? They are whining and dining that company at crazy nosebleed valuations. And then everything else just sort of sits there. And it'll be something where two people have both spun out of the same, Mag 7 employer, have similar backgrounds. They both started interesting deep tech companies. One's the belle of the ball, the other can't get a call back. And so, the valuations that we saw around Gen AI, that sort of madness, which has definitely died down, was really sort of situated on a couple specific names that all the investors decided, hey, if everybody else is meeting with them, I've got to send them a term sheet with a higher valuation, less about sort of any deeply differentiated foundational tech or models that those companies were building.
It makes me wonder how you're thinking about the valuation question and any comparisons to the dot-com boom and bust cycle that we saw, Sarah. And we've got a chart here just indicating you can barely even see. We're comparing where we're at right now versus the run-up in some of these big tech names in the dot-com bubble. Just huge run-up in that white line and representing the early aughts there versus your green line, barely even tracking that white one on your screen for those watching right now. Sarah, what do you make of those comparisons in terms of valuation concerns that we are at a dot-com boom level with the AI rally right now?
You have to remember that in the dot-com boom, we probably don't remember, right? We were not exactly trading then. But you have to remember that at the time, these were companies that were literally just, hey, I have a pitch deck. I'm an MBA with a pitch deck, and I'm going to go IPO because I need to raise hundreds of millions of dollars to even really launch a website, right? And so certainly now you can build real tech companies. You can be a very smart person building a very real company on very, very, very little money. So no, this is not the dot-com boom, which is probably a little bit more like, the tulip craze in Amsterdam hundreds of years ago. But at the same time, I think you do have to keep an eye on looking even at your own life and your own businesses. Where are you spending your money on things like AI, right? And how is that actually going to work? What would get you to spend hundreds or thousands of dollars a year in your personal or professional life on AI? Because if you're not doing that, then you do have to wonder, how are these companies actually going to make money? You see OpenAI, will come out with new models, and it started at kind of tens of dollars a month, and now it's hundreds of dollars a month. Really? Just so that I can get like an incorrect recipe instead of Googling it? That feels expensive to me.
Really great reminder, Sarah, and thank you so much, as always, for breaking down the tech trade for us. Appreciate your insight.
Thank you.
Coming up, we're taking a look at some of today's trending tickers. We'll get you the news behind those moves next on Catalysts. It's now time for some of today's trending tickers. You can scan the QR code on your screen here to track the best and worst performing stocks of the session at Yahoo Finance's trending tickers page. First up, we're taking a look at quantum stocks rising today after falling last week when NVIDIA's Quantum Day failed to wow investors. At the event, NVIDIA CEO Jensen Huang walked back previous comments he made back in January, casting doubt on the timeline for quantum computers, saying the useful technology was more than a decade away. But this time around, he changed his tune, saying he was the first CEO in history to invite guests to explain why he was previously wrong on quantum. Now, what's really interesting, Anne, is that we saw a little bit of a sell-off in quantum. I think that's not what Jensen wanted to necessarily do. He was trying to kind of ease concerns, saw a little bit of a sell-off, and now we've got to return back to the upside today.
We have returned back to the upside, but can we just go through some of these numbers, Maddie?
Yes.
I've got Yahoo Finance up on my computer in front of me. It's showing me that as of 12/31/2024, total revenue for D-Wave, just under $9 million, right? The market cap of this business is north of $2.8 billion. I mean, that's valuation. Whether it's a little bit of a sell-off or a lot of a sell-off, just the valuation we're now seeing in quantum is, it's astronomically high.
Especially given what we've been talking about all morning, there's currently a question about whether AI will actually be profitable, useful. Will people pay for ChatGPT? I don't even think we've gotten to the idea of that question with quantum.
That's right.
But correct me if I'm wrong.
No,
I mean,
that's right.
is there proof of concept to the degree that it is something people are willing to pay for at this time?
It's a great question. It feels as though AI has gone through the cycle of, okay, here is something really unique. That's when ChatGPT launched. It wasn't actually unique. It's just consumers sort of found it for the first time.
Right.
To this sort of, oh my gosh, this is amazing. Wow, this is what the next chapter looks like. To the sort of phase of critical thinking. Mm-hmm. To your point, will it work on time as quickly as we think? Does it provide the kind of money that, the profit that we think it will? Quantum feels like it's back over here yet, where it hasn't exploded into public use yet. Yeah. Those who are enthusiastic about it are really sort of evangelists for it. And I just think we don't know. We don't know, but this is expensive stuff.
This is expensive, and I love that you bring up the valuation piece. It's interesting, the CEO of D-Wave has come on the show several times, including the last couple of weeks, to talk about the company earnings. And when you ask the CEOs of these companies the use case, they can't even believe the question. They're like, it's quantum computing. It does something a computer could never even dream of doing, but real world, what does that mean? What is the profitability? And I think that's a little bit of a disconnect between the engineers and the investor community, perhaps.
There is one conversation I did have, and it wasn't with the CEOs. It was actually with the former deputy director of the National Security Agency, who's now gone into venture capital. And I said to him, what are the top 3 things that keep you up at night? What are the threats? And quantum was actually one of them. Wow. It was actually one of them. And there, the threat case was the sheer capability of quantum to computing, to accelerate and magnify cyber threats in particular. So, again, how do you put money around that? How do you quantify the ability to invest behind it? I think still a little unclear, but to your point, the stories around the use cases at least seem to be out there.
But that's a really important anecdote too, just in terms of potential defense spending that could be a catalyst as well. So lots of great things to continue to monitor there. But another sector we want to look into here, automakers rising on those reports that President Trump might exclude the auto sector from those new tariffs that are set to take effect April 2nd. The coming wave of reciprocal tariffs now expected to be more targeted than originally thought, reportedly focusing on certain countries that have the biggest trade deficits with the U.S., what Treasury Secretary Scott Bessent has called the Dirty 15, those key 15 countries. And you can see, obviously, a hugely positive result for the automakers this morning. I think what's fascinating here is that this comes in the context of those tariffs and the tit for tat on tariffs already developing between Canada and Mexico. Those will still have an impact on the automakers. That threat hasn't gone away. It's just the lack of an additional threat on top of it that is leading to this lift in these stocks, which I think is interesting that is enough to lead to a little bit more optimism here.
I think that's right. And the Ford CEO said, look, if you're having more tariffs across the US, Mexico, Canadian infrastructure, these are highly integrated auto supply chains, and I think it's words where it could blow a hole in the industry if we see more tariffs here. And I think, we do forget in this tariff conversation, just because one country has a tariff levied on it and another one doesn't suddenly make the tariff exempted country more compelling to do business with. We do have these global supply chains. We do have components moving from one nation to another. All of this cost is going to end up lurking in there somewhere. And I think ultimately it's, how quickly does it hit the consumer pocket?
Right. And there were those original reports, and we spoke with someone who did some of the number crunching and said that cars could go up by as much as $12,000 per vehicle off the back of these additional tariffs. And it's interesting that, again, that threat has not gone away, that there is still this idea of parts that are having to be passed between the U.S. and Mexico. Mexico is where we get the majority of our cars from the United States perspective. So that threat is still there, and yet there is so much relief that there just isn't anything worse, that we've already gotten the worst news for now when it comes to these auto tariffs.
One thing we haven't heard about so much in the auto space is actually company-specific exemptions. If you look at tech, do you remember in the last administration, Apple got exemptions actually on certain components that are coming in from China. So we haven't had that yet in auto. I do wonder a little bit if that ends up going in that direction.
Really great point. Will there be some more deal making moving forward, and what will that mean for the individual auto stocks? And then we also have earnings coming up, so maybe we'll get a little bit more color from that as well. A lot of potential catalysts going on here. But coming up, we're going to be talking Tesla and Musk with a shareholder, as the automaker is still looking to snap its 2-month losing streak. Stick around for that conversation next. Retail investors appear to be coming in to buy the Tesla dip, shares up over 10%. The company looking to snap that 9-week losing streak. This comes after Elon Musk told investors to stick around.
So it's very difficult for people in the stock market, especially those that look in the rearview mirror, which is most people, to imagine a future where suddenly a 10 million vehicle fleet has 5 to 10 times the usefulness. So what I'm saying is hang on to your stock.
Here with more, we've got Kristen Holm, Nia Impact Capital founder and chief investment officer of an asset management firm that focuses on activist investing. Just some context for our audience. And Kristen, we're excited to speak with you because you are a Tesla activist investor. You told us that you sold most of your stock back in 2022, but you've kept some shares in your activist portfolio to keep engaging with the company. Why keep those shares and give Elon what he said he wanted there?
Hello, good morning, and nice to see you. So we held our shares because of the amount of Tesla employees that we've spoken to over the years that have shared issues of discrimination. And we want to see change at the company, particularly for shareholders as well as for employees. So we've asked for the removal of forced arbitration, which is a concealment clause that covers up any incidents for employees. And we've also asked for stronger oversight from the board on human capital management.
And Kristen, what has the impact of that been? Were you able to get any of those things that you just laid out that you asked for?
Yeah, actually, just this year, the board has agreed, and it came out in their 1099 about being able to and willing to oversee human capital management, particularly issues when it comes to what we call strong human capital management, or DEI, hiring, looking to basically have the very top talent and to be able to retain that at Tesla.
Kristen, let's take that a step further and talk about, though, the composition of the board. You know, when I take a look at who's on there, you've got Elon Musk, founder and CEO himself. You've got his brother. The chair of the board is the former CFO, so a former employee of the company, and includes some Silicon Valley stalwarts. The question is, will any of these board members be willing to stand up to or defy the man with the Midas touch at the end of the day? Even if they are taking on HR oversight, would you expect them to act?
Well, so that's actually a really good question, and that's one of the main reasons we don't hold Tesla in client portfolios, is because we expect all of our companies to have CEOs that report to the board, and clearly that's not happening at this company. So there are some significant risks in governance.
And Kristen, just taking that another step further, when you think about where Tesla can go from here, what are your thoughts more broadly on whether the kinds of considerations that you've raised are going to take hold more broadly across the shareholder base? It feels like retail investors are backing Tesla as it stands right now.
Yeah, it's a really good question because Tesla does hold the promise of really disrupting the entire automobile industry. We can't argue that they have not already done that. However, we are looking to see the innovation that they've promised come to fruition. There is some talk of rolling out fully automatic driving in China. However, China already has competitors that have lower price points. There's also talk of rolling out additional automobile types in Europe. However, Europe has all sorts of protests going on. That was a main driver for automobiles, and the brand has been damaged, both in California, strong place to buy and sell Teslas, but however, the amount of retail Teslas that have been resold in the last month is at a peak. So the brand really has been tarnished, and can they come back from that? That's what I think we all really need to see.
Do you think they can come back from that, Kristen?
It's a good question. It's very similar to tariffs in that the Canadians are switching now to not buy American products. When the tariffs come, when they go, when they come back, they will already have shifted their buying and their consumer preferences. I believe similarly, particularly for the US, where cars are almost an extension of our personality, we really get serious about our cars and our choice there. And it's almost like our personal branding. So it's going to be really difficult, I believe, particularly in the US, for Elon to come back. Now, whether they shift and start grabbing market share from some of the Doge supporters, that could be a really interesting play for investors, though we're not anticipating that at this time.
Kristen, I want to zoom out here because I am flooded with questions on social media these days from people who want to know whether if they do have an activist investor slant, should they even be invested in U.S. stocks? Where can they be looking for opportunities, especially as so many companies are pushing back on DEI initiatives in particular? What is your message to those investors who are looking for ways to put their money to work that match their values as well?
Yeah, well, it's a really good question there. And what we see is that we actually really like the word efficiency, which is interesting because it's being used very broadly for different terms. But we want to see strong human capital management programs in place because we see that to be the most efficient. We want companies to be able to attract, hire, retain, promote top talent. And particularly when we're looking at the AI and tech sector where innovation is really driving a lot of the stock price, we want to see the top talent to be able to do that. So pulling back on any investments in talent, in employees, in human capital management we would consider to be not efficient. Whereas tech seems to be moving now to this moment of do more with less. We want to see actual investments. We want to see companies that are putting employees on the asset side of the balance sheet and not on the expense side. So that's where we're looking to see more investment.
Really great overview, Kristen, with Naya Capital. Thank you so much for joining us today. I appreciate it.
Thank you.
Coming up, venture capital seeing its biggest surge in 3 years, how AI is fueling the frenzy and impacting the market. That's next on Catalysts. AI chip startup Furious AI has reportedly turned down an $800 million takeover offer from Meta. The Korean company instead choosing to grow its business independently, planning to raise capital before eventually going public. Meta reportedly had been in discussions about acquiring the company since the start of the year here. And as a reminder, for those not familiar, Furious AI develops semiconductors for AI inferencing and second-generation processors as well. It does aim to kind of challenge some of the big wigs in this industry when it comes to chip giants here. So it's interesting to get this kind of buck of confidence from the company saying, no, Meta, we actually don't want your offer here. We want to do it on our own.
This reminds me of two stories actually where it could go both ways. And I think this is really specific to Meta. You know, when Facebook bought Instagram for $1 billion, I think Instagram were delighted to be bought. You now look at valuation of Meta, and a $500 billion valuation is ascribed to Instagram, right, 13 years later. So that just goes to show, if you have the confidence to say no and wait it out, it can actually yield dividends. Same with Wiz turned down Google last year at a $23 billion valuation. Here they are getting acquired 1 year and $9 billion more later. So, you know, courage of your conviction, good for them.
It makes you wonder, if you are a company that's getting an offer from Meta, you should just know that means that your value is going up. That's a huge sign of confidence that Meta wants you, and why take that initial offer? I think makes a lot of sense to kind of hold out for more.
Yeah, I do. I think to your point, actually, is are they really holding out to go public? Because, you know, you'd say they want to raise some capital. I think the number's about $48 million pre-IPO preparation. Or it's just as a way of saying, look, we're up for sale. Anyone else out there who wants to come and lob a bid in, we'll see. It's an interesting sort of little bit of game theory around this one.
It's such a great point, and something that dovetails perfectly in the conversation we're about to have, which is the activity we're seeing in private versus public markets. And is this a moment that's a little bit of a sea change where we will see more opportunity in the IPO space and more activity versus some more of that private capital funding for these AI names, which just feels limitless at this moment. So we're going to continue that conversation. The growth of AI fueling those big investments, with venture capital firms pouring into the space. U.S. fundraising climbing to about $80 billion in the fourth quarter of 2024, according to PitchBook. Joining me now, Kyle Stanford, PitchBook's senior venture analyst. Great to have you here, Kyle. I want to start on this CoreWeave IPO in particular. I wonder to what extent you think that CoreWeave's IPO is indicative of a broadening and a revival of activity in the IPO market.
Yeah, that'll be tough, right? I think CoreWeave obviously has a great company. They have a great model. They've grown incredibly fast and raised a ton of money. I don't know that they're necessarily going to be an indicator for the IPO market for other companies, right? We're really seeing a bifurcation in the activity in the deal-making space, where you have AI raising about 50% of the capital, and that $80 billion, $10 billion of it was to Databricks. The rest of the market is having a still really hard time raising capital, finding the funds they need to continue growth. So it's becoming a very different market than I think the resurgence from the data perspective would show.
Kyle, talk a little bit about the kinds of venture capital that's been backing businesses like this. CoreWeave, backed by NVIDIA. That's one public company that does invest venture capital from its balance sheet. Salesforce is another. Do you think that those kinds of big public companies backing startups creates halos around some versus others?
Yeah, if you look at across the biggest names in VC, OpenAI or XAI, they all have huge corporations on their cap table, right? These corporations are trying to keep up and become the forerunners of the AI space, and so investing in these really high growth, fast moving, great new technologies from the startup space is where they're going. So it's a much different type of investment than your typical VC, right? I mean, think about Sequoia and Andreessen, they're in that game too, but majority of the VCs are under $50 million. They're not backing these businesses, and they're kind of missing out on the, barbell effect that AI has created. So, these corporates, NVIDIA, Microsoft, Amazon, all putting money in is really going to help inflate those deal sizes because they're able to put that cash behind the companies.
Is there perhaps something sinister going on when it comes to private markets right now, given, OpenAI set most recently at that $260 billion valuation. Obviously, the sky seems to be the limit when it comes to private funding for these companies here. And then you have a trickle of IPO news, CoreWeave, Klarna, StubHub even. Is that a sign that there's some pain in private markets, that the spigot's getting turned off?
I don't think necessarily, right? I mean, StubHub is a good example, right? They've been private for quite a long time, and so continuing to raise private capital, I don't know their exact cap table, but they might not have the equity to sell, so they might be pushed into the public markets. We also need to think about the LPs in these VC funds. They need liquidity. The secondary market has gotten a lot of buzz over the past few quarters, but it's not nearly big enough to provide the liquidity to these LPs that is really needed from these VC-backed investments. So IPO is kind of the natural move for a lot of these unicorns, and whether it be OpenAI or someone like StubHub who's been a unicorn for quite some time, like that push is necessary. It doesn't mean the spigot is being turned off in the private markets. It's just the necessity to move into a different financial market institution is kind of being pushed forward for them.
Carl, let's talk a little bit about how this all translates into the actual funds themselves in the venture capital world. One of the things that we've seen is the deals have been getting bigger, but a lot of the funds have been getting bigger and bigger as well. Funds that used to raise several $100 million to $1 billion, now raising multi-billion-dollar funds. That does make it harder to get the kinds of returns on each of those bets that's going to get the sorts of fund dynamics that VCs have been used to. What's your thinking on that?
Well, I think they're going for a completely different type of return, right? If you're investing in these, ultra late stage companies and holding a smaller portfolio of these investments, you're probably not seeing 75% of the companies go out of business like you would if you were investing in seed and Series A, right? And so when you talk about, again, Sequoias and Andreessens that are really raising these multi-billion-dollar funds, they're not looking at the traditional venture market. They're investing in higher quality businesses or businesses that have at least gone through multiple funding stages. They can put on more traditional due diligence practices and really help kind of flesh out the risk that venture is typically associated with. Now, Andreessen also has, and Sequoia as well, seed funds that are investing in the early stage technologies, but the median fund size is still under $50 million. And so when you talk about these large firms raising these multi-billion-dollar funds, it is still, again, a very small handful of firms that are raising it compared to the broader venture market.
And then talk to me, Kyle, about what you're seeing playing out in public markets and how that might be playing into any skepticism that we might be seeing in those private markets moving forward. Obviously, a lot of volatility in the broader market off the back of tariff headlines and a slew of other potential headwinds here. To what extent does that play into venture as well?
Yeah, well, one thing that startups really hate when they're trying to go public is volatility. So right now it's been pretty short term, a month or so of heavy volatility. That probably won't have too big of an impact right away of this IPO market. It's been so slow for so long, and CoreWeave's going out, which I think will give a little juice to the market. But I think as volatility, if it goes into a second quarter or increases more, and there's more uncertainty pushed into the market through tariffs or any other sort of legislation that is, unseen before, that's going to have an impact on companies that maybe don't have the story or the hype behind them to go public in this market. Those companies will need to figure out a way to lengthen their runway and make sure that they're ready to hold off on an IPO for 2 quarters, 3 quarters, maybe till next year. Again, the length of the volatility will have a big impact right now. We don't see it impacting the numbers too much, just maybe pushing some of the IPOs a few months later into the year.
All right, Kyle, we got to leave it there. Thank you so much for joining us. Appreciate it.
Yeah, thank you for having me.
We'll have all your markets action ahead here on Yahoo Finance, so stick around for more. You're watching Catalysts. Another trending ticker we're watching, SMCI. Goldman Sachs downgrading the stock to sell from neutral, saying they view the risk reward as unfavorable given downside risks on valuation, competition, and gross margins. You can see shares of Supermicro Computer down about 2%, bucking what we're seeing in the wider trend of a lot of the tech and chips names in particular moving to the upside this morning. But Anne, we were just looking through the note together. A couple of things stuck out to both of us here. That pressure on gross margins, the idea that transitioning from the Hopper to the Blackwell chip from NVIDIA, it's going to cost them, and that's going to hurt their margins. Yes, they still see a revenue story, but not enough in terms of the outlook moving forward for the stock that the run-up has already sort of priced in, it sounds like.
It's that little phrase you snuck in there, Maddie, which was not enough. Let's just read what it says. Goldman's saying we expect SMCI to more than double its 2024 revenue by the end of 2026. That's within 2 years, but still not enough. And it feels like the story of NVIDIA, right, which has just had fabulous earnings quarter after quarter. But the earnings outlook, the revenue outlook has been just not enough. This really just feels like another example of how expectations are the name of the game in the whole chip sector.
And another great example, just to me, in terms of evaluating stocks, that it's really about the earnings growth. Like, it always comes back to the earnings growth. We talk so much about SMCI, the accounting issues. Is the CEO going to remain the CEO? All of this back and forth. Will they get delisted? And ultimately, what it comes down to, and our quick look at this didn't even mention from Goldman, the accounting issues. It's about the growth story for the company moving forward.
And a lot of conversation about the valuation relative to peers. One example is Dell is a comp that keeps coming up in this report as we read through it, basically saying, SMCI too expensive relative to Dell and some of the others. And I don't think Dell is really one that we thought of as cutting edge as some of the other names out there. So it looks as though this focus on fundamentals is coming back into play.
Certainly coming back into play in perfect timing as we are heading right back into another earnings cycle here. So something that we will continue to be monitoring as we start to get those earnings in. And thank you so much for joining us this hour. Excited to have you back again soon with us. Hopefully, we appreciate it as always. Going to do a final check on the markets for us before we head to break here. You're still looking at gains across the major averages here. You've got your S&P 500 up over 1%, your tech-heavy NASDAQ moving up nearly 2% here as well. Actually, just over 2% of gains on your tech-heavy NASDAQ here. Again, those tech-heavy names, including NVIDIA, leading the market this morning. Coming up, we've got Wealth. It's dedicated to all your personal finance needs. Our very own Brad Smith, he's going to have you here for the next hour, so stay tuned for more.